Picture this. You open your investment app on a Tuesday morning. The market is down 4%. There's a war somewhere. Inflation is still sticky. Your coworker just told you he moved everything to cash just to be safe. And for a split second, you think about doing the same. Sound familiar? Here's the thing. That moment, that exact pull you feel to do something, to protect yourself, to get out, that is the most dangerous financial moment you'll ever face. Not because markets are falling, but because of what most people do next. Look, I get it. The world genuinely feels unstable right now. Between geopolitical tension, interest rate uncertainty, AI disrupting entire industries, it makes total sense that your brain is screaming danger. But here's where it gets interesting. A study by Dalbar, one of the most respected financial research firms in the world, tracked investor behavior over 30 years. You know what they found? The average investor earned just 3.7% annually. The S&P 500, it returned over 10.5% per year in the same period. Same market, massively different results. The only difference? Behavior. Specifically, what people did when things felt scary. Now, you might be thinking, okay, but this time really is different. Things are unusually uncertain. And here's what most people don't realize. There has never been a time in history that didn't feel uncertain to the people living through it. 1987, Black Monday. The Dow dropped 22% in a single day. People said it was the end. 2001, 9/11, followed by the dot-com crash, end of the world. 2008, global financial crisis, actual end of the world, or so it seemed. 2020, a literal pandemic shut everything down. Every single time the instinct was to flee. Every single time the people who stayed, or better yet, kept buying, came out ahead. The market doesn't reward the people who feel the most confident, it rewards the people who act the most rationally when confidence is hardest to find. Let me show you this with real numbers, because this is where it gets almost uncomfortable. Say you had $10,000 in the S&P 500 starting in January 2000. That includes the dot-com crash, 9/11, 2008, COVID, all of it. If you stayed invested through all of it, your $10,000 would be worth roughly $72,000 today. But here's where it gets painful. If you panicked and missed just the 10 best trading days of the market over those 24 years, you'd have under $33,000. You lose more than half your gains by missing just 10 days out of roughly 6,000 trading days. That's 0.17% of the time. And here's the kicker. Most of the best days in market history happen right after the worst ones. So if you flee during the crash, you almost certainly miss the recovery. So why do we keep doing this? Why do smart, educated people still flee when things get wobbly? Because our brains were not built for modern finance. There's a concept called loss aversion, first identified by Kahneman and Tversky in the 1970s. It says that the pain of losing $100 feels psychologically about twice as powerful as the joy of gaining $100. So when your portfolio drops $5,000, it doesn't feel like losing $5,000 on paper. It feels like a threat, and your brain, the same brain that kept your ancestors alive, wants to run. Think of it like this. Imagine you're playing a card game where you know the house wins 70% of the time over 30 years. Every bad hand feels like proof the game is rigged. But if you know the long-term odds, you don't fold, you stay at the table. Smart investors don't feel less fear. They've just built systems that remove the decision from the moment of fear. So what do smart investors actually do when things feel unstable? Here's the playbook, not theory, actual steps. First, they automate. Set up automatic monthly contributions to your index funds or ETFs. When you don't have to decide, you don't let fear decide for you. This is called dollar cost averaging, and it mathematically means you buy more shares when prices are low. Second, they rebalance, not retreat. If stocks drop and bonds hold steady, your portfolio drifts. Smart investors bring it back to their target allocation. That literally means buying more of what's down. It's counterintuitive, and it works. Third, they hold cash with intention, not to hide from the market, but as dry powder. typically 3 to 6 months of expenses in a high-yield savings account, currently earning around 4.5 to 5%. This way, you can handle emergencies without ever touching your investments. And fourth, they consume less financial news. I'm serious. Studies show that people who check their portfolios daily make significantly worse decisions than those who check quarterly. The news is designed to react. Smart money doesn't react. Here's what I want you to take from this. The world has always been unstable. It always will be. The question isn't whether things will get scary, they will. The question is, are you building a financial life that doesn't require the world to be calm in order to work? The gap between average investors and great investors isn't intelligence, it's not even timing. It's the ability to do nothing strategically when everything in you wants to act. So the next time you feel that pull to move to cash, to wait it out, to just see what happens, remember, the market doesn't care how you feel. It only remembers what you did. Start automating, stop watching, stay in the game. And if this helped you think differently about your money, like, subscribe, and I'll see you in the next one.